Yeah, some of these some been too heavy to be sitting in my lap. You ain't lying about that. All right, now let's get straight to the point because you guys are here because you already know the dividend capture game. You understand the mechanisms of buying before the ex dividend, capturing the payout, and selling. You don't need the lesson on the four critical dates or the basic theories. You're here because you know the real challenge isn't understanding the strategy, but in executing the strategy profitably. So we all know the central problem. The ex dividend date price drop in a perfectly efficient market. This makes the entire strategy a zero sum game. You gain a dollar in dividends only to lose it in the share price. But the market isn't perfect. And our jobs as capture strategists is to exploit these small inefficiencies. The question for quarter four, 2025, isn't what is the dividend capture, but rather how can we build a system that consistently beats the drop, then manages the risk, and maximizes the velocity of our capital. The goal isn't just to find one or two trades, it's to create a high frequency income stream. And this requires moving beyond random chasing of yields and adopting a professional, structured approach designed specifically for the opportunities and risks of the coming quarter. So, how do we tilt the odds in our favor? We fight the market's efficiencies with our own operational efficiencies. That's going to be the one way to do it. The core of our quarter four 2025 plan is a pre planned sequential dividend hopping calendar. Now, this isn't about finding the single best trade, it's about executing a series of reasonably good trades in rapid succession. This systemic approach is designed to tackle the strategy's inherent flaws head on. So, first, it maximizes capital velocity, and idle cash is the enemy of compounding. Instead of capturing one dividend and then searching for the next play, our calendar dictates the next moves immediately. The moment we exit stock A, the capital is already allocated for buying stock B. And this speed is what generates the compounding effect that we're after. Michael says 5 acres of timberland, 60,000. Harvest the trees, divide into 1 acre lots, sell each lot at 75,000. Well, that's a lot of work. That's a lot of work. And it's a lot of money because while some logging companies might buy the logs off of you, the trees off of you, they will still charge you for cutting the fuckers down in the first place. And the other idea about that, while that's a fantastic idea, buy for 60K and then sell for 75 times five. That's phenomenal. The downside is that you can only do that once. I mean, if you buy another 5 acre piece of property for 60,000 and then mow it down and then sell it off, you could probably do it a second time, but you're not likely to always fall on a 5, 10, 20 acre piece of property every year, every week, where you can stack the cash up in it's a seemingly realistic fashion. It's just highly improbable for the average individual because not everybody has enough capital to throw down 60K, and not enough people have enough money to close out on a mortgage, and not enough people have the know-how on how to negotiate through all of that with somebody else's money. Oh, Michael says work. I have the machines. Exactly. So if you had to pay tree trimmers, you'd have been losing out on a lot of money on that. He said it hurts my thumb to swing that boom. But why are you swinging booms? Don't you got kids? in the barn, they should be out there swinging that boom. Don't you get? Don't you got faculty and staff out there swinging booms for you with team leaders out there keeping the crew motivated? 1932 style. Come on, man. Either way, um, either the joystick is what moved those machines. Oh man, see, you're doing it the modern tech day way. I would have took it back to the old school, baby oil and whips. But no, it is a good idea. That is an alternative divestment. It is not impossible. It is just hard to get yourself in there. Is that I'm laxy. I'm lazy as fuck. It's just a dynamic. Um, Coming down to buy the first property. A lot of people can dance in on the FHA. A lot of people can tiptoe across like Navy Federal and other credit unions that will give them little to no down and walk them through background checks, financial checks, woohoo, and then get that first property. Now, if you make more money than you're spending and you're not trying to max out 80 or 90% of your income, you are likely to have enough capital to lean towards getting another mortgage. But not everybody has enough money to go cash up front. Not everybody has that buddy that will go in on that investment deal with them, that'll help them with funding it. And when you start thinking about going into real estate, from being turn your pockets inside out and prove how broke you are to let me just buy a 5 acre piece of property so that I can hold it for 2 or 3 months and then sell it. You know, that takes a lot of money because they would have to have that even so much as 60 or 70,000 for the year accessible so that they could relocate that capital towards something else. That they will learn. Oh yeah, they're gonna learn. We're gonna teach them. Is that if they really want something in life, they will learn. Oh yes, things that are worth having are worth fighting for. That's always a saying. Um, in my family, we stress on the "I can't" not being an effective word in the dictionary. However, uh, people use it a lot. People use it more often than they should. It's not that you can't. It's that you either don't want to, or somebody with more control over your situation than you is stopping you from doing it. It's not that you can't. You either want to or you don't want to. You're more likely to succeed with whatever the task is if that's what you want to do. You're less likely to succeed with the task, no matter what task it is, because that's not what you want to do. He says, down payment on the 60,000 owed is 12,000, much cheaper than that new car. Yeah, yeah. Depending on what new car you're getting, because some new cars might allow you to put like $5,000 down, but it's still a waste of money for a $60,000 vehicle. Because I mean, shit, the bitch is only worth like 35, 40,000 when you drive it off the lot, minus the cost of how many miles you put on the car. Now, the second thing we have to think about with this dividend capture strategy is it manages risks through stock selection and disciplines. So, chasing your highest yield uh, accounts is a classic mistake that leads to holding volatility and high risk stocks that are likely to drop for many. And this is going to go far over the amount of the dividend. Now, our calendar focuses on a balance of healthier yields from relatively stable to high liquidity stocks like real estate investment trusts and established blue chip companies. And we prioritize predictability over the raw yield. Third, it enforces active risk management where not only just by a hopping scenario, every single trade on the calendar will be governed by hard rules, specifically to use for stop losses and other orders to prevent a catastrophic loss from an unexpected market event that we wasn't ready for and didn't know nothing about. He said return on investment. Yeah, that's exactly what we're working on. Now we also use strict position sizing. Uh, this discipline removes the emotion that kills profitability. We execute the system, not our gut feelings. And man, this is going to be the methodology. It is a disciplined, mechanical system designed to turn a specific speculative idea into a repeatable business and the process that goes with that business, where its assembly is for dividends income in quarter 4. Damn, drop my lid. You ever get started and you get burnt out? And he's like, damn, shit got me some extra coffee. Yep, that's where we're at right now. So, for the next part, this is the part that you've been waiting for, and we're going to keep this part short. This is the plan that we've built a calendar of for opportunities in October and November designed to allow for a continuous hop from one X dividend data to the next. Now, you need to remember that these are projected dates based on historical schedules, and you must verify the first declared X dividend date as they are announced. So, this is our working blueprint. We have proven this in real standings. October 2025 dividend hopping planning is going to be another one, but the first hop plan is entirely October, and ticker TWO for Two Harbors Investment is going to be one of the ones that we're going to be getting into first. The target date for that one is going to be October 3rd. So as we start grabbing some of these stocks, you'll be able to take a glimpse of what we're potentially going to be working with coming October. And trying to see if I can throw it. There it is. I'm like, I know I hit the control alt button trying to throw it into the comment section, and that's it came right back. Like, nah, you straight. Now, the next one is going to be global net lease. And after the third, a week later, we're looking at global net lease, which is going to be October 10th. And your third hop, where it's almost like you are like I was trying to think about how does that play out. You've done 3. It sounds like you're playing musical chairs with these, and you're bouncing around from one to the next. Oh, that's what I was trying to do. I was trying to put that in there so that you've got that target. Look, I'm on 3 different screens trying to throw it all in there for you. Make sure that everybody got what they need. All right. Now, that one is going to happen October 10th. Hop number 3 is going to be mid-October, and this is going to be our trusted buddy, Arbor Realty and Armor Residential. Both of them are ending on ex dividend date of the 15th. And in this situation, you're going to end up having to split one because they're too close together, or you're going to be laying it in on some of the the other investors and let them pull back the profits that you left on the table. for those individuals who are still figuring out how to get that borrow down. Now, the fourth hop, and I think we got like 15 hops, but we're going through just October 1st, and then we're going to go through November right after that. Our fourth hop in late October is going to be PSEC Capital, which is Prospect Capital Corporation. And all of these tickers are on the bottom of the screen, but they are available. And instead of them uh, giving you the ability to pay them to find these stocks and get out there and get your trades in, you can follow me and find these stocks and get your trades in. Now, these stocks, PSEC Corporation is going to be sitting on, at Orchid Island and other ones, is going to be sitting on October 28th. Now we're going to hop to the fifth quarter. And the fifth quarter's got a whole mission. Or not the fifth quarter, but the fifth hop has no mission. And this one was supposed to have in late to early November, ORC, which is Orchid Island Capital, having an ex dividend date around the 21st. And then November 25th, they just didn't feel like sharing anything. But November 25th, unlike Thanksgiving, is going to have hop number 6, which is going to be the Exxon Mobil stock targeted to flip on November 13th. So here we go. See if I can get that in there. Look, you feel like I feel burnt out. Well, there was so much information. I spent 3 hours putting this stuff together for you tonight. And then I also got my hands on the information about the Tylenol story that you told me about yesterday. So there isn't a lot to go on with this first half. Probably be able to finish it in the next 30 minutes of all of the stuff you need to know about the next 2 months worth of dividend rotation. Then we're going to spend all of our nifty time talking about how Donald Trump says some stuff about Tylenol, autism, and letting everybody know that you must still pick cotton to make your pain go away. I myself recognize that every time I forget where I came from, I open 3 bottles of aspirin and 2 bottles of Tylenol, and I remember that that is 5 balls of cotton that I did in the air conditioning. Back in the day, there was no air conditioning. Woo. We wow. Now, the next target date, actually coming up around my birthday, November 13th, is going to be based on a typical historical pattern. And this is going to be hop number 7 in mid November. This is our Arbor Realty stock that we made so much money on a couple months ago, and the Armor Residential stock that is the next day. These two are always back to back with one another. You cannot get one and slide into the other all the time because the ex dividend date of one is the day before the ex dividend date of the other. And especially when they ride on the weekend, that's when you end up in a situation where you're only going to get one of them that Friday. And then you just got to, you know, rub your fingers together. But this is going to be like Thursday through Saturday kind of thing. He said, "Who's going to be on it? It's mine. That's the one who's going to be there. It's mine." And I'm gonna do absolutely. I'm gonna be right here on the podcast. I might have a cupcake or some shit up here. That's that's it. I'm gonna be trading stocks and making money. I ain't even trying to make a couple phone calls, wish some people happy birthday because their birthday is not on that day, but they forgot my day, so I'm gonna call them and remind them about their day. That's how it works. Uh, but these guys are going to be between the 14th and the 17th. So You'll be able to, if you pick them around the before the 13th, whichever one you're going to grab, then you'll be able to make your success story on it. Armor Arbor Realty typically holds its yields better and typically walks away with a little bit more at the end of it. But Armor Residential has a lot more volatility, and if you catch it while it's down, it does go back up above what you bought into it. So even if it takes that hit for the shares, it's still higher than what you bought into it, and that's one of the reasons why we hold on to both of those. Oh, yours is so you like a day after me. So that means we're gonna be we're Scorpios. We're gonna be running around. Charisma men. That's how it is. Is that I knew you were smart. Well, great minds think alike. I know we're gonna have a whole month to conquer the live stream. That's what we can't take over the world. We're too old for that shit. You see, we getting tired here. We only been doing it for what 30 minutes. Didn't even at 31 minutes. Didn't even go over a large quantity of the nonsense. But you do realize that when it is an abundance of information being packed into a very short period of time, you come to find that information overload makes you brain exhaustedly tired, and you will find yourself sleepy time long before. And then when the information stops flowing in, you're like, whew, second wind of energy. Where did that come from? Yep, I was one of those kids that slept in class. Uh, but I always got straight A's in the front of the room. You know how fun it is to sit in the front of the room, right in front of the teacher's desk, taking a nap? Best part was when my teacher used to stand over my desk and I couldn't see her face because her chest was in the way. Golden. Now, the next jump is going to be in late November, and that's going to be to RM regional management stock and Cord stock, which is Cord Energy stock. That's one of our energy power company stocks that we talk about. And this one is going to have an ex dividend date. These two, because it's both of them, is going to have ex dividend dates between the 20th and the 27th. And these are ones that you should also try to get yourselves on. Um, as long as they're not trading over the weekend, there's a probability that you can slide right into um, RM stock from Cord stock or vice versa. But it really depends because I didn't check exactly what day out of the week it is. I got the dates down. I just don't have the days of the week down. However, I know that last month we skipped over Cord stock, Energizer stock, and DHT stock because Energizer took a dip on that Monday. DHT was due well, no, Energizer was due on Tuesday. DHT was due on Monday. We was trading out of ABR on a Friday, and we did not have enough time to trade into DHT because the money didn't clear until Monday, and we was not going to be able to make the money off of Energizer, so we jumped into RM stock. And by the time we got out of RM, we because again we were back to trading on the weekend, we did not have enough time to get into the cord stock, so we slid straight into, if I remember correctly, PSCC and made bank off of that instead. However, if we're not trading on the weekends with some of these stocks, we can slide right out of um, regional management into Cord stock and then right out of Cord stock into Orchid Island. But you got to be careful with that because since RM stock and Cord stock is between the 20th and the 27th, you understand that Orchid Island Capital, PSCC, uh, and AGNC are all on the around about the same date between the 28th and the 31st. Orchid Island is widely known, but PSEC actually has a slightly lower cost, even though it does have a slightly lower um, even though it does have a slightly lower percentage rate because the PSEC stock is like less than $3 a share. You can buy two stocks of PSEC stock for one stock of Orchid Island stocks. So PSEC stock is giving you like 18 or 19% return, and Orchid Island stock is giving you like 17 or 18% return. So you're getting a little bit more on your PSEC stock. And this is happening towards the end of the month. He says, have you lost any money in the stocks? Um, when we first started out, there have been times where I took a loss in order to release money to start the dividend rotation capital in May. Then I made massive gains because I started doing a dividend rotation strategy. Then there was one time where I scheduled it to sell because the app that I was using had a sell date different than what I was anticipating. It sold the night before instead of selling the morning of, so I wasn't on the books and I missed one of my dividends. So now the plan is to after midnight schedule the sale. Don't even schedule the sale the day before. Schedule the sale the day of. And these are the things that you learn throughout. But have I taken a financial loss where now I have less principal than what I've started with? No. Even though I've been trading on a small scale for this experiment, less than $5,000 worth of money we're moving around. The fact is that we've made more than $1,000 since June. So the fact is that it is because we're in a bull market, the growth of the stock is not nearly as important to you as the dividends when you're doing the dividend capture platform, because there are going to be times where you're going to sell and take a loss, and there's going to be times that you're going to sell and get a gain. And at the end of the year, as it pertains to taxation, you're going to get taxed on all of the growth that you sold and benefited from, and all of the dividends that you had when you walk out of the end of quarter four. And since everything is moving, everything is taxed regularly. So if you have $500 of growth out of the year and you have $500 of growth out of the dividends, you're going to get taxed on $1,000 worth of taxable income. And anything under $11,000 is going to be taxed at 10%, which means that you owe the government $100 for the dividend rotation strategy between June and December. That's how that would go. He says, so you're learning. It's not so that I'm learning. It's the idea that I'm doing it on a different platform. And because I'm doing it on a different platform and I'm doing it in real time, the stock trading on the stock market wasn't the issue. I'm able to trade when I need to trade. But trading on a platform that I'm trading on now is a different platform than what I would have been trading back in the day using TD Ameritrade. And as a result, because this platform, the Stash app, actually trades like ETFs. So I put up the monetary value towards stocks on the platform. I get the X dividends anyway, but I can sell it a lot faster. The money clears a lot faster. I don't have to do cover calls and cover puts, uncover calls or uncover puts. I don't have to do any kind of option trading. I can just say, hey, here's $5,000 towards those shares, and then I get that much money back in dividends. And if there's growth, I experience growth. If I have a marginal share, I experience growth on a marginal share rate. If there's a loss, I experience loss on the same level. Um, the plus and minus of that is that when you're doing ETF trading, if you put up an uneven amount of money where you don't have a full share somewhere in there, you have a percentage of a share, and let's say the total portfolio went or not the portfolio, the total stock went up, say $100 in value. If you sold the $100 difference between what you bought and what you have, you're selling a certain number of shares. If the stock goes down below what you bought in, and then you buy $100 worth of shares, you had $100 worth of taxable growth that you did potentially walk away with, but it wasn't. It was like pennies on a dollar per share, and then you bought back in, and that's when you start seeing an experience. So the goal is to have more shares to your name if you're living off of the benefits than what it would be to have more growth per share. Because you could have one share of TikTok stock at $9,000, or you could have 9,000 shares of TikTok stock at $2. That's the difference. So when it grows, the more shares you have, the more dividends you get if you're getting paid dividends per share. Now, if it's a growth stock, you really want to have each share just grow. But if you're living off of the dividends themselves, you want to get as many dividends as you can when a stock market takes a dip, so that when the stock market goes back up, you still have more shares there. He said that's an excellent return on your investment. Yeah, it's a damn good return on my investment. The fact that I'm able to put up 5 G's and walk away with a G, I did the rotate when we were talking about this last month, and we was talking about just sitting on 10 grand and making probably 1,000 to $1,500 over the course of 12 months. Where I just told you from June to December, we didn't shot past $1,000 with less than $5,000. We didn't have 5,000. We were actually trading between and $4,000 is what we were trading with, and we've already crossed over $1,000 worth of money since June. So by June, by the 12th month of doing this, we might have would have walked away with like $1,500 to $2,000 worth of traded capital, and we're just bouncing from share to share, which gives us a larger quantity of money to spend on. And it's a fantastic way to go, but it's only this successful because we started in a barren market. And now, as the market is increasing, as we're coming out of the chaos, as TikTok sales is going to settle, as tariffs start dissipating, as commerce starts soaring again, as real estate starts happening some more, as interest rates start going down, as interest companies that benefit from interest rates are starting to benefit from more loans going out, the market is starting to improve. And as the market improves, we're trading into undervalued stocks, because these are the stocks that took a shit dump over the past 5 years. Where had we been doing this 5 years ago, we would have been pissed off right now. But the fact is that because we got it now, nobody else wants them. They are the highest paid, most volatile stocks that you can get yourself into. So outside of these stocks going bankrupt, where you lose your principal, you're riding a wave of stocks that can spiral back up into a big profit. So yes, it is some good investments. He says there's always a learning curve in life. Uh, to some, it is easy, and to others, that curve might feel like a wall. I'm gonna be honest with you. The learning curve was, there are some individuals that are fast learners, and there are some individuals not so much so. For those of us with an IQ closer to 125, we have a little bit better of a position with adapting to retaining knowledge and application of knowledge. I understood in college that there isn't much real world application, just the history of why it is what it is. And when you start utilizing critical thinking, you start assessing how things could happen. The difference between, there are a lot of smart people out there, and some of the problems that they have is that they're just too broke to take their knowledge and apply it. Um, I'm gonna roll the dice with it. I'm like, the bills are paid. I got extra money. Instead of going to the club, buying a few beers, hanging out with the homies, movie night, bowling night, surfing night. Fuck that shit. I'm gonna sit on here with the podcast and take the money I'm not spending going out and throwing it into the stock option, see what it can do. And it turns out it's doing a hell of a lot more. I'm doing more with less, utilizing strategy, than what most people do working on a 9 to 5, going to work every week. Now, Michael said, I'll take the TikTok. I would take TikTok too. Now, $5,000 uh, seeding the bank at 0.1%. It ain't even 0.1%. It is 0.0064, or actually, it might have slid down a little bit to 0.0054. It is it is nowhere near 1%. It is like a fraction of a percent. Like, you would have to put down $1,000 to get half of a percent. So to get one penny on your investment in a bank, you got to put down 2 grand. That's what the interest rates are looking like right now if you're doing what you're doing with the bank. So that's why we do what we're doing, because Just like I told you last month, that if we would have been doing this with 10 grand, we would have made $1,000 in 30 days. We would have made $2,000 in 2 months. If we would have been doing this dividend rotation strategy with uh, uh 40 grand, the exact same stocks that we hit last month and this month, we would have been making $4,000 a month off the stock option. Yeah, we would have been paying taxes on that shit. But if you can move 40 grand around to make $4,000 a month, you're making 48,000 a year. Not a lot for a lot of people, but for those folks that's making 45 and 50,000 a year, working 40 hours or 50 hours a week, if you had 40 grand in the bank and you can make 48,000 a year off of that 40 grand in the bank, turning that 40 grand into 80 grand and turning 80 grand into 120 grand. By the time you got to 120 grand, making an extra 240 grand, you would have quit your job and you would have just been flipping money in the stock market like, fuck it, I'll send Uncle Sam a check. It is what it is. Is that some of the smartest people out there are real dumb? You're right. Some of the smartest people out there are too smart for their own good because they think they know it all and they don't think about the consequences of their decisions. They look down on people because they're used to people not being capable of, and they fail to appreciate the differences of knowledge. I don't know everything about everything. I know a little bit about a lot of things, and I know enough to get me by. Now, I rely on everybody else that fact checks me on this show to be able to provide me with knowledge and information that I was not aware of because that wasn't important to me at the time that I did the research for the podcast. And that gives me even more knowledge and even more information. So, a homeless person, a high school dropout, a middle school dropout can bring me information and I will action on that because nobody is too good to pass knowledge to somebody else, and nobody is too down to be retaining knowledge that somebody else needs. Is that everyone out there better be listening? He said, I know enough to get me into trouble. Well, I know enough to get me out of that trouble. So I might have just a tad bit more knowledge. But as you guys can see, the dates that I was giving you guys off of the dividend rotation strategy are staggered and they are creating potential sequences. If we roll capital from um, what is it? To stock, TWO stock to GNL stock, then from GNL stock into our choice of ABR stock or ARR stock, and so on. In some cases, you have multiple options allowing for diversification or the choice of the stock with the best setup on trade day. And that's one of the things that you have to remember. Oh, I have street cred. I no longer have street cred. I am a phantom. I'm not even a ghost. I am a phantom. You only hear about me after it happens. No one knew about me before it happens. But when it happens, that's when everybody recognizes I should have had street credit. I'm the legend that nobody talks about. He who shall not be named. And then when I enter the room, he's here. I heard about something like that happening before. He's the one that did that. That's how my reputation precedes me. Now, the calendar that I gave you guys is a foundation for the first 2 months of quarter 4 campaign. And this is where the rubber's going to meet the road. I'm going to walk you through the exact process. First, we're going to build your ex dividend calendar. The calendar is the foundation of our whole strategy because we need to find a sequence of stocks with ex dividend dates that let us hop from one to the next. If you get these dates in advance, you're now not selling a stock and then searching for a stock to buy, which is what day traders would do is they would have research today what they're going to sell tomorrow, or research yesterday what they're selling today. With us and a dividend rotation strategy, we are guaranteedly holding on to and paying attention to specific stock that we're going to get rid of a certain amount of, because you don't have to sell the whole stock a lot of the times. Sometimes you can just sell 90% of it and leave some of it there, and dividend rotation strategy for the rest of it, especially with your monthly payers like Orchid Island, PSCC, AGNC. Those are ones that pay every month. Instead of selling the whole stock just so that you can buy it next month, you sell the portion of the stock that you want to rotate into something more expensive, like when we're rotating into AGNC. It's good to have AGNC as your stock, because not AGNC, AG Mortgage. It is good to have AGNC as your stock because it does have a decent quantity of growth, but it's good to have AG Mortgage because AG Mortgage right now is cheaper than Orchid Island. Well, not really. It's like 10 or 15 cents, 20 cents difference. But sometimes it's cheaper and sometimes it's a little bit more. However, it is still really close to $7, $7 to $8 per share, where Orchid Island is between 7 and 7.20 per share. So they're a few cents off from one another, but Orchid Island is giving you 12 cents a share as a payout, and AG Mortgage on the exact same day is giving you 21 cents a share on the payout, which is double. So for $2,000 worth of, or 100 shares of Orchid Island, 100 shares of Orchid Island will give you 120 bucks, and 100 shares of AG Mortgage will give you $210. These are so instead of holding on PSEC, that yeah, they might give you 5 cents a share, and you might be able to buy 3 shares of PSEC for the same price as 1 share of AG Mortgage. You're still only getting at 5 cents a share, 15 cents for 3 shares of PSEC instead of 21 cents for 1 share of AG Mortgage. So you have to balance how much you're trying to gain versus how much it costs for you to gain that, and then roll your money. And as a result, you don't want to sell your whole PSEC stock, just enough of it to make getting your AG Mortgage quarterly stock worthwhile. Then the following month, you put it back. Now, when you're buying and selling like this, regardless, ignoring the taxation of things, sometimes if you buy it a week before, 5 days before, you can catch it at a dip, ride the rise, and then experience the return. But there are going to be some times where you're going to feel the rise, experience the dip, sell the stock, and the loss in shares is almost equivalent to the ex dividend value. But you're not focused on the growth of the stock. You're focused on the ex dividends, because the next stock you roll into might give you twice as much as what you lost on the last stock, but you lost on growth, not on dividend. Think about that part. So financial websites and dividend screeners are going to be your best friends if you're trying to figure this out using automation. But if you came to this and that, where we talk about this, that, and everything in between, and you pay attention to what we got scrolling across the bottom of the screen, you can see all of the stocks that you need to be paying attention to, and then rotate in and out of those based on historical schedules and company announcements. Here's a sample of the calendar that we'll use for our quarter 4 plan. Now, remember, these dates are based on past schedules, and you must verify them 2 to 3 weeks before the ex dividend dates to verify and confirm that those dates are still set in stone for anything that is more than 3 weeks from now. So we understand that uh, I do believe Two Harbors on the 3rd, that's actually happening. ABR around the 15th, that's actually happening. PSCC around the 27th, AGNC around the 28th, Orchid Island around the 30th, those are actually happening. Some of the other stocks, you have to check and double check. Um, Armor Residential on the 16th, the next day, of Arbor Realty, that's actually happening. Those dates usually hit on the same date every month that they hit. It's just a different day of the week. So, starting with our hopping calendar, Two Harbors Investment, October 3rd. Global Net Lease, October 10th. Arbor Realty and Armor Residential, October 15th. So you got to buy these the day before. Prospect Capital Corporation is going to be October 28th. Remember, I told you guys about this one. Y'all got to grab these stocks out the comment section and put them to work. There's the next one. Then in November, because we're coming out of October, sliding into November, Orchid Island. And sometimes you can sell PSEC on the 28th and it'll clear on the 29th, buy Orchid Island on the 30th, as long as that's a weekday, and have Orchid Island for the 31st. Doesn't always happen that way. But after you do that, we're sliding into November. We don't have anything happening at the beginning of November. So the very next thing that we slide into is ExxonMobil. And we slide into ExxonMobil. This one's going to be around November 13th. And that's why I told you guys. So right around Michael's birthday, grabbing ExxonMobil. Then we have ABR a few days later. So just as soon as we sell ExxonMobil, we're getting Arbor Realty and then Armor Residential, as long as we're not trading on the weekend. And then we come out of that to go after regional management stock, Cord Energy stock. We should be able to slide into DHT stock and Energizer stock, as long as we're not trading on the weekend. And that will lead us to back to PSEC and Orchid Island for the end of November. Notice the pattern? The dates are staggered, letting us roll our capital from one stock to the next, where one $10,000 stack of money could hit each one of these stocks in succession. Sometimes the stock is going to be up, sometimes the stock might be a little bit down, but you're rolling out an average of $10,000 in the same $10,000 into each one of those stocks. And if each one of those stocks is putting out a stack of cash, then the gains that you get per month are more significant for the same quantity of money than what it would have been if you did a buy and hold with an average of 15%, or if you would have just left it in a bank account as an emergency fund account. Now, sometimes you're going to have multiple options on the same day. This is going to give you that flexibility to split your money, or you're going to pick one that looks most promising. Then the step two is going to be the trading life cycle. You want to nail the execution. So you want to know the dates is one thing that's going to keep you on time. But then executing perfectly is going to be another, because just like I told you guys before, if I schedule it too soon on the night before the ex-dividend date, I might sell it before the ex-dividend date by accident, thinking, oh, it's going to sell in the morning. It might not sell in the morning. It might sell tonight, depending on my platform. So I have to be up at 4 in the morning, scheduling that sale for 9 o'clock in the morning so that it happens on the ex-dividend date. You have to execute it perfectly. And we're going to break down the hop. He says declaration date, ex-dividend date, record date, payment date. That's right. And they're not all the same date. The declaration date happens a few weeks before the ex-dividend date. You have to buy before the ex-dividend date, sell on the ex-dividend date so that you are the date of record. And then you're going to be able to get your payment on the payment date. And sometimes the payment date is a while back, but you have to be on the date of record on that stock as a holder, so that the ex-dividend date is the first date that they sell without the dividend, that you're going to be able to get whatever trade that you're going to get. And sometimes the stock bounces back where people are buying in on the ex-dividend date, and then you're good to go. Is that if not, the money goes to the seller. Yeah, somebody's going to get it. Somebody's going to get it. When it comes to buying, your timing is critical. You must buy before, not on the ex dividend date. And to be safe, the rule is to buy at least 1 to 2 days before the ex dividend date. That way, everything settles and you're already on the books. So, for a hop with an ex date of October 10th, you need to buy by the end of the day on October 9th at the absolute latest. The hold is going to be the easy part. You just have to own the stock when the market opens on the ex dividend date. That's it. Don't get too anxious and try to pre-schedule a sale the night before. Because your app might actually sell your shares because other people are trying to get in. They'll make a trade just because there's trades pending. Once the market is open, you are locked in for the dividends because you're scheduling your dividends shortly before the market starts open. Now, the sell is going to be the art of the exit. This is the trickiest part. So we know that the stock is expected to drop. So when these sell, option A is going to be sell at market open. And this is the most mechanical approach. The moment at market open on the ex dividend date is you selling will give you the most profitable option walking out of the sale. This is going to get your cash back immediately so that you can prep for the next hop, especially when you have back to back shares. You have more time for the money to clear. If it sells at the beginning of business day today, it'll be ready tomorrow and you'll be able to roll it into something else before the end of business day tomorrow. Because if you're using ETFs, you might have 1 to 2 business days, and if you have 1 to 2 business days, you might be able to clear that money faster if you sold it at the top of the day instead of selling it towards the end of the day. The upside is going to be speed and discipline. The downside is you will take whatever drop the market gives you. Now, option B is going to be waiting for a rebound. We've tried that before, and it it worked one time, but it didn't work another time, and they broke even. Sometimes a stock drops at the open and bounce back a bit. You can set a limit order to sell at a slightly better price. The upside is a potentially smaller loss on the stock. The huge risk is that it doesn't rebound and keeps falling, forcing you into a bigger loss or tying up your capital and ruining the whole sequence. Because if you buy in, and I told you this before, to prevent from experiencing the actual financial loss, you don't sell until the stock goes back to your buy-in value or above. But if you're trying to rotate that capital into something else, you stop the rotation with the capital that is stuck below sale value or below buying value so that you don't take the loss, but you lose out on the rotation capital. Now, if you are going to take that hit regardless, you lose more by waiting than what you do by selling at the top of the hour. Remember to check your dates. Which date are you supposed to be selling? Don't get too anxious. Now, my preferred method for the highest frequency strategy, like you doing this the way Speed Kings is doing it, is leaning towards option A, selling it at or near the open. It keeps the calendar on track. The goal isn't to squeeze every penny out of one trade, it is to successfully execute a high volume of trades that are all paying dividends. The redeployment is the best part of this because this is the hop. As soon as you sell the order for hop one, you go through to your immediate next stock, which is hop three. And with the cash from selling the two stock on August 3rd, or sorry, October 3rd, you're getting ready to buy global net lease before October 10th and your constant cycle buy, hold, sell, redeploy. And as you have now, you're looking at an extra step in your buy, hold, sell because you have buy, hold, sell and rebalance or buy, hold, sell and get your dividends because as you sell on the ex dividend date in September, you're going to start seeing if they're not paying you in the same month, you're going to start seeing in October dividends being added as you're selling from last month's ex-dividend dates, and then you're going to take that extra money and rebalance it into the next dividend rotation. So just as the cash clears, you're rebalancing into the next dividend rotation. Now, if you're buying and selling stocks on a regular basis like this, you are going to develop a little bit of a cash stream. And if you're moving the money around in an efficient fashion and you see a financial conflict up above, like coming about, you might sell a little bit of the stock instead of rebalancing it into the next stock in a dividend rotation. You might deposit that money into your account. So, say something happened, you had an emergency, you charge it to the credit card just to cover the bases, but you know you don't have enough money to cover the card. Let's say you needed $1,000 to replace the money you charged onto the card. Well, if you're rotating out $4,000, you can leave $1,000 untraded and put $3,000 back into the next trade if you're dividend rotation, not really taking a hit because you were making that trade regardless. And the $1,000 you drop it into your bank, and by the time you're ready, you could put $999 onto your credit card, bring it down to a $1 balance, let the billing cycle roll over, and put that $1.50 on there and zero out your card, and the emergency is covered. The risk there is high because if you're going through the throes of the stock market and the stock market takes a fucking dump like it did in April and it went down 700%, then you would lose a larger quantity of your principal and you would not be able to recoup that. But if you are in a bull market and you're paying attention to this, you can either buy and hold or you can rotate in and out and make you a decent cash stream. Now, the next thing that you're going to deal with is going to be risk management because your financial fire extinguisher is going to be how you minimize your losses. And yeah, it's going to be partly diversification. But doing this without a safety net is going to be financial suicide. So you're not taking all of your money and throwing it into one individual stock. You're taking a large percentage of it and putting into there, and then leaving the rest of it somewhere else where you can minimize the loss between the two. But you're going to be rotating things in and out. So these are going to be your non negotiables. First, position size. Never go all in on one trade. Those who do, who are riding the risk of volatility, while yes, you will get a massive reward for each time you go all in on one trade. But you remember that when that one trade is not in your favor, you're taking more losses than what you would if you diversified. But if you decide on a fixed amount of capital for the strategy, 4,000, 5,000, 10,000, if you're an up and comer and you're going all in on a dividend rotation strategy to build yourself up to $5,000, and then you're going to take everything over the $5,000 and hold it somewhere, that's fine. If you're trying to build yourself up to a $10,000 dividend rotation strategy, and then you're going to leave the remaining money sitting somewhere else, that's fine. Once you reach your goals, then everything above that goes into whatever shares you're going to be using for your core satellite strategy that we talked about before. After you've gotten your fixed amount, then use a fraction of it for each trade. Now, this diversification ensures one bad trade doesn't blow up your account. So if you're using a percentage of your money, so out of say $4,000, you're trading with $3,000, and out of $5,000, you're trading with $4,000. That's a very huge risk. But if you lost $100, you could take $100 out of one of your standstill stocks, put it into your dividend rotation, go and make $200, and then put that $100 back because you have extra money in some places. That's a very risky, volatile way to do things. But if you're dealing with small money, you're trying to not only learn a dividend rotation strategy, but also benefit from the dividend rotation strategy, and you're okay with the risk, take that chance, slide into it. Stop loss orders. This is going to be another way that's going to help you. This is your eject button. When you buy a stock, immediately place a stop loss order below it. A good rule of thumb is to set it just a bit wider than the dividend yield. So if the stock pays a 3% dividend, a stop loss at 4 to 5% below your buy price protects you from catastrophe. You want to maintain a trading journal. I typically set a bunch of alarms on my cell phone and they just keep letting me know what's going on. But if you keep a detailed record of every single trade that you have, entry price, exit price, dividends captured, the cost, and your net profit and losses, this data is going to be priceless, especially if you do it on an Excel spreadsheet, because it will show you what's working and what isn't, which stocks are performing better than others, and what the strategy's true profitability is. By following these steps, you turn a high risk gamble into a structured, business like operation. The theory is going to be great. Nevertheless, if you try to see how this plays out in real world scenarios, you might get different outcomes. So let's take a hypothetical $10,000 portfolio and walk you through it. First few hops of our quarter four calendar. Uh, Assumption for our simulation. Starting at $10,000, your transaction cost, and we'll assume it around $5 for the cost. Buy and sell to an account for spreads and fees. Fine. Price drop, we'll assume the stock drops on X dividend date by 80% of the value of the dividends. This is an optimistic but plausible scenario. Hop one, mid October, we kick it off. October 15th, our target will choose Arbor Realty Trust. The data, hypothetically, ABR stock price on the 14th, around $15. ABR quarterly dividends, about 43 cents. A 2.87% yield for a capture. Execution, you buy it on the 14th, you invest $10,000, buying 666 shares at $15 a share for a total cost of $9,990. You're going to hold it overnight. Ex dividend date hits. The dividends is 43 cents a share. We expected 80% price drop, which is about 34 cents. The stock opens at 14.66. We sell the stock, 666 shares. We're selling $9,763.50. The dividend capture uh, for 666 shares was $286.38. The capital loss on the trade was $226.44. The transaction cost was another $5. The net profit was $286.38. So if you take the difference between the two, we actually had a $54.94 gain. A small win, but it's a win. More importantly, our capital is now free for the next hop. He says $10,000 to cost $5. It dropped 80%. Target. Oh, we're broke. Yeah. Well, and that's one of the reasons why I traded with ETFs, because with ETFs, I pay $3 a month for unlimited trades. So I wouldn't have that $5 cost every time I trade. I also trade into stocks that don't have that dip like that, so I don't have to deal with that loss like that. But still better than the bank because it's $54 for that one trade this month. We're still in the month and we're about to trade again. So target two, October 28th, Prospect Capital Corporation, PSEC. That's going to be a company known for monthly dividends. Your available capital right now is $9,763.56. Hypothetically, overstating it, it would be $6.50, which is technically 3 times more than what it is right now. But let's just say that it was. It's giving 6 cents a share, which is a 0.92% yield. Execution date, you buy it, you invest the available capital, buying 1,499 shares, which is going to be about $9,743. That's going to be held. And then the dividends is going to be 6 cents a share. Your expected price drop is going to be like 5 cents a share. So the stock opens at $6.45. Now you're going to sell that 1,400 shares where you're taking yet another loss. Out of the dividend capture, the 1,499 shares got you $89.96. The capital lost on that was $74.95. The transaction cost for another $5 is $89.94 with a net profit of $9.99, another $10. You've made $64, another small win. But notice the yield was smaller, and so was the profit. So this shows how important the dividend size is relative to your cost. Oh, he says, remember to like and subscribe. Oh, definitely. Ride the wave with us. Now, if we're going through this particular type of scenario where you're hitting more losses than you gain, because most of the ones we've been hitting this year. Because really, think about this though. If we would have traded on the actual value of PSCC, let me do this for you real quick because I'm giving you a hypothetical on loss over loss, and the reason why a lot of people run the dividend rotation strategy. But Prospect Capital Corporation is currently $2.59 a share. And it is still giving that 5 cents a share scenario. But if we bought the original $9,743.50 worth of stock, and you can do the math with me and verify, Michael, $9,743.50 of stock divided by the current $2.59 per share for this stock, you would have 3,761.9 shares. Now, if you multiplied that by the 5 cents per share that they're giving you, it would have actually been $188, not just a simple $88. Now, if you look at the dip, the dip was correct. It went down just a little bit, and you would have lost $74.95 per share on this particular stock. Even if they would have charged you the extra $5, you would have had $79.95 loss on this. But if you would have lost that with the actual value of this stock, we're gonna go ahead and take $79.95 off of the stock. You would have walked away with $108, which is far larger than the hypothetical loss that we're talking about. But this hypothetical loss that we're talking about is the reason why people run away from stocks. But this stock actually would have gave you a pretty decent gain. You would have had $100 gain, not a $10 gain. And if you'd add that to the $50 gain that you just got with the other thing, you would have had $164 gain. So it would have been a pretty decent win. Then when you go to trades gone wrong, this is one of the ones that Michael was talking about the other day, just yesterday. So targeting some in November. If we take a dose of reality, let's see what happens when things don't go as planned. Now, we're going to target ExxonMobil, blue chip company. We got $9,668. Dive in, $110 a share, 95 cents per share payout. Overnight, the oil prices drop unexpectedly and the whole energy sector sells off. Execution date, we invested 87 shares at $9,570. Totally unaware of what just happened. The dividends come out 95 cents a share. The price should drop by about that much, but because of the bad news, ExxonMobil opens down $3 at $107 per sale. We're going to sell it. We're sticking to the plan. We're selling with $9,309 that we're getting back off 87 shares. We would have gotten $82.65, but we would have lost $261 plus the $5 transaction fee. In this situation, we would have lost $183.35 on the deal. This is a crucial lesson. And we still captured the dividend, but the market moved against us and created a much larger loss than the total quantity of gains that we would have made out of all three trades. This is the primary risk of the strategy, live in action. And this is one of the reasons why you're not supposed to put your entire portfolio into the dividend rotation strategy. After 3 hops, you would be in the hole $118 if you're not paying attention to the stock. Even with 2 wins, one big loss could wipe out the entire game and put us in the red. This is the brutal reality. But this is not a guaranteed profit machine. It is a game of averages, and the goal is that over dozens of trades, the small wins from successful hops will outnumber and outweigh the losses from the bad ones. It takes a strong stomach to stick with the plan after losing trades. It hurts. When you miss the ex dividend date, it hurts. When you're selling under, it hurts. When you take that L, but when you rotate into the next one and you make back far more than what you lost in the last one, that's when you really start feeling the value of the platform. So after our simulation, we're down over $100. Was it a failure? Not necessarily. It was a lesson. It shows you that you're not going to win every trade. So the key is to have a positive expectancy over the long run, meaning your average wins is bigger than your average losses, or you win far more often than you lose. Our simulation tells us two critical things. Avoiding big losses is everything. The ExxonMobil trade shows how outside factors can wreck a good plan. And this is why risk management rules are not suggestions, they are gospel. A properly placed stop loss would have capped that loss that we were talking about with ExxonMobil, turning a major setback into a small, manageable one. So, your number one job is not to maximize gains, but to protect your capital. Stock selection is huge. Our most profitable trades are ABR stock, and that had a yield of 2.87. Our loser in this example was ExxonMobil stock, and it had a low yield of 0.86%. This suggests that we need to focus on stocks where the dividend gives us a big enough cushion to absorb the price drop and cost. But this has to be balanced. Crazy high yields are often a trap, and the sweetest spot is the stock with a healthy but not outrageous yield and a history of being relatively stable around its ex dividend date. It could have a 30% dividend return, but if it's a volatile dividend return right around the ex dividend date, where it usually plummets right before the ex dividend date, more so than what you benefit from it, you might want to get into a week and a half early, see the rise, and sell before the ex dividend date because you're going to get more off of the growth of the stock 8 days before the ex dividend date than what you're going to get from the loss of the stock on the ex dividend date, which is why paying attention to the behavior of the stock throughout the month is heavily important, which is why, as I have those stocks running across the bottom of the screen, I pay attention to each one of those stocks every day. The path to profitability here is a grind. It's about executing the plan flawlessly dozens of times and letting the stats work in your favor. It's about letting your small wins pile up faster than your manageable losses. And this is not for a passive investor. I'm going to tell you that. It is not. If you're going to do a buy and hold and you're going to sit on your money for a while, then you're going to have to figure out another way to do this because what we're doing right now is proactively forcing 3 times more money into your pocket with each trade every month. This is going to be for active, disciplined traders willing to do the work, track the data, and manage risk with an iron fist. Now, we are deep in the weeds here. And if you find this detailed breakdown valuable, do me a quick favor and make sure that you hit that like button, hit the subscribe button, hit that notification button because it really helps the channel and tells YouTube that you want more real in-depth financial content like this. If you're following us on Twitter or Twitch, make sure that you take the time to hit that like button and hit that follow button. Greatly appreciated. Now, while theory is great, let's look at a brutal real world lesson in risk that just unfolded yesterday. This is the kind of event that can destroy a dividend capture plan if you're not prepared for it. Now, again, we're going to start with that $10,000 transaction cost. Well, the $10,000 investment option. And then we have that $5,000 transaction cost for the buy and sell. We have the safe bet gone wrong. The Kenvu catastrophe is what we're calling it now. So let's say the dividend hopper identifies KVUE, the maker of Tylenol, as a target. If you would have been dealing with that on Monday, you'd have been dealing with a bad day. It's a stable consumer health company, seemingly a safe bet for dividend capture. The data, based on real events, on Friday, September 19th, 2025, Canvu's stock closed at $18.34 per share. A trader decided to buy in for an upcoming dividend. By September 19th, we invested our $10,000, buying 545 shares at $18.34 for a total cost of $9,995.30. We're holding the shares over the weekend, expecting a routine trade. Here comes the X factor. Monday, September 22nd, news breaks that President Donald Trump, alongside Health and Human Services Secretary Robert F. Kennedy Jr., has made statements linking Tylenol's main ingredient, acetaminophen, which I don't take because I'm allergic to, is an increased risk of autism when used during pregnancy. So all the women in the United States with a child that has autism is running out there for that class action lawsuit attributing autism to Tylenol painkillers being taken during pregnancy. The White House announced a plan to update Tylenol's labeling and urging caution those black label scenarios, and through the claims lack strong new scientific backing, and Kenvu strongly disagrees with the connection, but the political shockwave and investor anxiety are immediately responding. So the ex dividend date, hypothetically, let's assume this is the ex dividend day. So the dividend we hoped to capture is now irrelevant because market opened on September 22nd and the market panics. Kenvu stock plunges over 7%, hitting record lows. Sticking to our sell at open rule, we are forced to dump our 545 shares at a new lower price, roughly $16.94. Our total proceeds are just around $9,248.64. And let's assume hypothetically we would have gotten 20 cents a share off of that. We would have gotten $109 off of 545 shares. But because of what just happened, we went in with $9,995 and walked out with $9,248, took a $746 loss before the $5 transaction fee, where the $109 dividends that we would have got off of the stock does not help us absorb the $746 loss. We're looking at a $642 loss out the whole transaction just because of one piece of news. One piece of news that completely unrelated to what we got going on, unrelated to the company's earnings or the financial health of the company, resulted in a catastrophic loss that wiped out the dividends nearly 7 times over. To make matters more psychologically brutal, the stock then rebounded by 6% to 6.2% the very next day on Tuesday, this morning, as investors digested the news and the lack of new scientific evidence supporting the claims. A trader who panicked and sold at the bottom locked in a massive loss, while one who held out have still faced gut wrenching uncertainty. But if they would have held out, they would have held out for less of a loss, where it would have been a 0.8% dip instead of the full 7% dip. This is the primary risk of the strategy, live in action. The dividends is a tiny magnet, but a tidal wave of market moving news can smash your entire plan in an instant. This hit a lot of companies. This hit Johnson and Johnson, CVS, all of the generic companies that are selling pharmaceuticals, Walmart, everybody, Sam's Club, everybody who's selling acetaminophen got hit with this. But Tylenol stock took the hit. Now, while the pharmaceutical company did take a short decline, it bounced back rapidly and it was quarantined just to the pharmaceuticals directly related to acetaminophen. The rest of the pharmaceutical industry was not impacted by this news. So after the real disaster with Kenvu, what's the lesson? The Kenvu event shows that you are not going to win every trade and that avoiding big losses is everything. The plunge happened not because of Kenvu's business performance, but because of political statements and the resulting media storm. This tells us two critical things. External risks are beyond your biggest enemy. The Kenvu trade shows how outside factors, especially with sensitive biopharma stocks, can wreck a plan. This is why risk management rules are not suggestions, they are gospel. Now, anybody who would have been playing the long game on that pharmaceutical saw that 7% drop and started buying in when it went back up 6%, they would have experienced a 6% gain on their buying. A properly placed stop loss, while still resulting in a loss, would have capped the damage, turning a portfolio crippling event into a manageable one. Your number one job is not to maximize gains. You're not trying to get every penny out of the market. You're trying to get some and walk away before you lose it all. Safe stocks do not exist because safe stocks do not have volatility, and no volatility has no growth. I mean, it has growth, but it is very minimalistic growth because there's no volatility. Kenvu seemed like a stable choice, but the Tylenol controversy didn't just impact Kenvu, it sent ripples of concerns towards all of the major retailers, like I was telling you earlier. So when I said Walmart got hit and CVS got hit, so did Walgreens, Costco, Target, Rite Aid, who were all defendants in a multi district litigation over their sale of that acetaminophen product. The hunt for a perfectly safe dividend capture is a fantasy. The quick rebound showed that the market ultimately felt the financial impact on Canva would be limited, but being on the wrong side of that initial drop is what devastates a dividend capture trader. The path to profitability here is a grind. It is about executing the plan flawlessly, dozens of times, and letting the stats work in your favor. So, since it's about those small wins piling up faster than your managed losses, our simulations proved that success isn't about those big wins. It is a statistical game of stacking up a lot of small wins while ruthlessly cutting those losses short. This is not for passive investors. And I said this to you guys earlier today, right before the halftime show. This is not for passive investors. It is for the active disciplined traders. So you must be willing to do the work. You have to track the data. manage the risks with an iron fist. Stay strong on this because our real world examples with Kenvu showed just how quickly a seemingly good trade can turn into a disaster because of an event completely outside of our control. It provided us with knowledge and information that proves success isn't about one big win. It's about statistical gains. It's about stacking up lots of small wins. Okay. Is your strategy the dividend rotation strategy, or do you have a different one? Are you a long term, set it and forget it investor? My answer is a hard no. The risk and effort just aren't worth it for you. But if I were doing it, if you were an active trader like me, if you loved process and have a discipline to take small losses without getting emotional, then this offers a fascinating way to try and generate a high frequency income stream. And if you're going to try this, start small like we're doing. Use the money that you can afford to lose, track everything, and be honest about your results, just like golf. What's the final verdict on dividend hopping for quarter 4 of 2025? Well, it's a powerful, high potential strategy, but it is also a razor's edge that demands extreme care. Now, we started with the simple, attractive idea of buying any kind of stock, just capture it and get the dividends. We then confronted the harsh reality of X dates and price drops, transaction costs, and unfavorable taxes that worked against us. Our solution, our secret sauce, is to fight back with the systemic calendar based plan. And this method maximizes how hard our money works, enforces discipline, and relies on a repeatable process instead of guessworking. Our simulation showed us both the quick profits and the very real losses. It provided us with success that isn't about one big win and its ability to recognize the statistical gains. With that understanding, I want to thank you guys for joining me on the deep dive. Hopefully, this look at the mechanisms is a reality of dividend hopping that was eye opening for you guys. And I want to know, what do you think? Is this a viable strategy or a fool's errand? Millionaires and billionaires might say it's a fool's errand because if you can put $1 million aside, not get taxed on it, and walk away with hundreds of thousands of dollars on the back end, you don't need to put any effort into getting your money. Your money is making money for you. But for those of us with less money to put into the investment portfolio, if you could put up $5,000 and bring back in less than 6 months 2,000 extra dollars, in comparison to other ways that you would have made money, you're able to make a lot more money in a shorter period of time using less principal. And if you want more in-depth strategy to build your wealth, and make sure that you subscribe, hit that notification bell so that you don't miss out on what we have next. Now, before we walk out the door, I want to say, ladies, as long as the situation doesn't make sense, I'm going to keep asking you, ladies, to make it make sense. So, ladies, please make it make sense. And fellas, I give you guys this information to help you guys become higher value men. You guys can utilize this information to stack your capital up in more than one way. And we have more than one option. Every Tuesday, there's an investment opportunity that we talk about. But, ladies, while this is a 65% male driven podcast from the male's perspective, this information is not exclusive to the fellas. Y'all can take this information, expand your knowledge, do your research, and learn how to invest for yourselves. You don't need a man to take care of you. You want a man to take care of you because you can take care of yourself. When you start fixing the things that are negatively impacting your life, you can find better ways to navigate your life. Work on the things that are inside of your control and then work around the things that are outside of your control. Once you have maximized improving proactively the things that you can change and not allowing yourself to be overly stressed out by the things that you cannot, you will find yourself more satisfied with the life that you live. With that being said, because we have tomorrow, we have a different country that we're going to be investing in, and then we're going to be putting up more shows because I do believe we've got to put up Sunday and then the rest of next week. So I want to thank you guys for coming to this and that. I'm your host, Xander, where we talk about this, that, and everything in between. And I'll see you guys tomorrow night.
Chase validation, now I validate myself. Building inner strength, putting doubt upon the shelf. No more unnecessary drama, no more wasted time. Climbing higher, constantly making my own climb. My network is my net worth. Choose your company wise. Surround yourself with eagles, not with sheep in disguise. Every interaction is a reflection of my brand. Quality over quantity, that's my personal command.
Thank you.